Thanks so much. And I'm actually going to take off from the last session in a kind of way, because I mean, the context is something everybody knows, so I won't waste much time on it. But basically, we all know that the pandemic was just, what is the opposite of icing on the cake? But it was that for global capitalism. In other words, it worsened things that were already very, very evident. We already had slow growth, decelerating investment, less global dynamism. And I think both Prabhata in the morning and everybody subsequently have kind of talked about that. It's required massive liquidity infusions. And as Oscar has told us, these can work both ways. They can be good and bad. But the problem really is that in a way, probably capitalism has been too successful for its own good, which is to say big capital has been too successful in destroying or eliminating anything that could have regulated it. And regulation in this sense means, for example, the ability to prevent it from excesses, whether in financial markets or with respect to nature and the environment, prevents the ability of workers to associate and trade unions to demand minimum workers' rights, prevents the kinds of welfare measures that would allow social protection and recognize the contributions of unpaid workers. All of that it destroyed. Having destroyed all of that, all the checks and balances, the powers of states and everything, it essentially meant that there were relatively less fields to conquer. And of course, I mean, as Professor Patnaik has been instilling in me since I was a student, it constantly needs fresh fields to conquer. And so that difficulty, the consequent underconsumption and lack of effective demand, yes, they're the outcomes of these inequalities of income and wealth and the falling wage shares. That's the evident outcome. But the real reason for those outcomes is precisely what I've said, which is that it's overdone. Large capital has overdone what it wanted to do. And then, of course, you get the COVID shock. And we all know that these very different levels of development determined the kinds of fiscal response that were possible. We know that the advanced economies were responsible for about 80% of all of the additional fiscal stimulus. But in fact, the US alone accounted for more than half, and that is before the latest thing that is being negotiated. But what we do find is that low and middle income countries, I'm going to use that term throughout because, I don't even know if they're developing anymore, and I don't know if they're emerging anymore, and I don't know if they're frontier anymore. So for me, low and middle income countries, this has to go back, I think, somebody. Yeah. Oh, yeah. Sorry. So these low and middle income countries have had to be so-called fiscally prudent, either because they're facing sovereign debt concerns and IMF conditionalities, or because they're terrified of capital flight. At least that's the official reason the Indian government gave us, that we will get downgrades if we spend more. And of course, now we know that the outlook for all of these countries is going to worsen much more. So I mentioned the varying fiscal responses, and as you can see, they vary dramatically between the advanced economies on the left side. These are just proportions of GDP. Yeah, 22.6 on average. Some countries are in excess of 35% of GDP, additional fiscal stimulus, and down to 2.4% for LICs. But let's just translate that into some approximate real numbers. If you look at the additional fiscal spending in the US between January 2020 and March 2021, it was $30,000 per capita, actually just under $30,000 per capita. The additional fiscal spending for low-income countries on average was $2 per capita. So that's what these percentages translate into. That's the kind of difference. And they even spent less than they did after the global financial crisis, which is the right-hand bar, which tells you that they were much more able to spend even in 2008, 2009 than they have done in this much, much worse economic position. We also know that 70% of workers in the developing world are informal, compared to only 24% in the advanced economies. And so lockdowns and closures affect them much worse. There's significant lack of additional social protection. And of course, that means there are no automatic stabilizers either that would somehow reduce the demand impact or of these shocks that we've talked about. Then, of course, there's the Ukraine war and the subsequent impact on food and fuel prices. And this is now blamed. If you look at the mainstream press, everything is about the Ukraine war. That's what has destroyed the conditions for emerging markets. That's what has created all these terrible conditions. And so it's Russia's to blame for everything, or whatever you want to call it, but it's the Ukraine war which is responsible for the mess. There's no doubt that there have been massive food and fuel increases since the Ukraine war. But please note, these prices started rising well before. Blue line is energy, red line or orange line is food. The gray line is fertilizer, which is the other one that everyone talks about with respect to the Ukraine war. Okay, and yes, definitely there's a very, very significant increase. I don't know if you can see the numbers, but the sort of from about here is the impact of the Ukraine war. But clearly prices had started rising. These major commodity prices had started rising well before then. No doubt about it, Ukraine war made things worse, particularly for oil or energy broadly and fertilizer. But these are only very partly related to the shocks themselves, to supply shocks. In fact, I'm going to argue that the supply shocks are almost marginal in the price increases, okay? The big changes have been massive profiteering by the big companies, big oil, big energy generally, big finance, of course. You know, we saw big pharma during the pandemic, but big agribusiness. We have had massive increases in profits of agribusiness and of, in general, the big energy and agribusiness companies, to the point where in the US, it's been estimated that of the recent inflation, 54% of it is explained by profits. Only about 8% is explained by workers' wage increases. And the rest of it is the famous supply chain issues that everybody likes to talk about. But in fact, today, US corporate profits are at the highest level since the 1950s. And the last 1 year has seen the most rapid rate of growth of corporate profits since data began to be collected. And as once again, I'm emphasizing, it's concentrated in these sectors: in finance, in energy, in agribusiness, in pharma. These are the big four areas where you're seeing massive profit increases. But in addition, there's massive increase in speculative activity. So we're back in a way in the world where we were in 2007 to 2009, where we had a global food crisis driven almost entirely by speculation in commodity futures markets. So there's a lot of interesting work done. The Paris wheat market, which is the benchmark for Europe, for example. Financial investors increased their open positions. In May 2018, they were only 23%. By May 2022, they were 72% of all the open positions. That's the kind of engagement of financial players. Similar stories from the Chicago Board of Trade. We find finance well and truly back into commodity futures and the commodity markets generally. Despite the Dodd-Frank law, which was supposed to prevent all of this, what really happened with the Dodd-Frank law is that while it says that everything should be in regulated exchanges and there shouldn't be over-the-counter transactions and so on, the ultimate way in which the regulations were enforced or the rules were laid down, especially during the Trump regime, raised the limits so significantly that pretty much everybody can now get into commodity futures. And they are indeed getting into those. So what's the interesting thing here is that the prices can go up very, very dramatically. Please look at the right-hand graph. And then they can come down again dramatically. So I'm not kidding when I say this is the same as 2007 to 2009. That's exactly what happened to the global wheat market then. Prices went up, more than doubled, and then came back to their previous levels. In the interim, developing countries faced massive food price increases. But in fact, when the global prices went down, it's not as if developing countries were better off. Because first of all, their currencies had depreciated in that interim period of crisis. But secondly, also, there is this ratchet effect operating in many developing countries in terms of the food price. So this, you can say, oh, well, you went through a bad phase and you're back to where you were. Not true. You're not back to where you were. In developing countries, food prices remain significantly higher. I'm saying developing, it's such a habit, LMICs. Okay, so the World Bank, of course, is full of, suddenly both the IMF and the World Bank are wringing their hands and saying everything is terrible and the world is in bad shape and these developing, emerging markets and developing economies are going to face the brunt of everything. We're really worried about them. You look at the projections, they're really dire, okay? The blue line is the past rate of growth of GDP, 2010 to 2019. The orange lines are the expected rate of growth this year and next year. Bear in mind that World Bank projections are always optimistic. They are always several percentage, sometimes several percentage points away, but they're on average about 10% higher than the actual. So what you're seeing here is actually much better than what will transpire. The total developing world, much, much lower rate of growth. But if you exclude China, we are declining. It's negative, okay? The low-income countries also negative. They have a category called fragile and conflict-ridden situation. I put it in there, but I'm a bit curious because so many of us are going to be fragile and conflict-ridden. And so, this premature decision to separate some into fragile and some not into fragile. Sri Lanka, for example, is not in the fragile and conflict-ridden at the moment. But nonetheless, as you can see, bad news. And of course, the news gets even worse. This is what the World Bank projects to be the cumulative projected output losses. So well in excess of a quarter, maybe, 1/3, close to 40%, beyond 40% for many economies. So overall, even they, who are generally always very gung-ho and, talking up economic processes, are accepting that this is a really bad time. But now here's the weird thing. Everyone says, oh, it's trade, it's the Ukraine war, it's the supply chain issues. And we all have to celebrate because one ship finally left the port of Odessa with some grain in it. And, now everything will be over. No, it turns out if this is the index of trade. So this is not rates of growth. This is the index of world merchandise trade in both value and volume terms. So what you will see is that, yes, there was a pandemic-related decline, but it was a very small decline, and it was only for one quarter. Otherwise, first of all, well before the pandemic, global trade was sluggish, stagnant. Yes, there was a quarterly decline, the second quarter of 2000, recovers almost immediately in the next quarter to the earlier level. The volumes stay the same, slightly increase in some years. The values increase hugely. And that's really because the higher prices that I have shown you earlier of, food, fuel, and fertilizer. But if you look at just the trade pattern, it's not something that would suggest the trade is creating this calamity for developing countries, for LMICs. And if you look at the major economies as well, you get a similar picture. So here, the left side is the US, it's European Union. So the US is blue, the European Union is orange, and China is gray. And of course, everyone says, oh, China is still doing very well and it's exporting much more, etc. Well, so is the EU exporting much more. And it's exporting much more after the Ukraine war started, okay? If you look at the BRICS, again, you don't find this massive decline. You find a 1/4 decline. The rest of the time, in fact, there's a significant increase. And particularly, again, Russia, the sanctions clearly didn't do much in terms of reducing Russian exports because they are booming. But India, South Africa, Brazil, nobody's doing that badly in terms of exports. So is it simply that the terms of trade have been so bad for us and that's why we're losing out, which is the usual other explanation? So I looked at the crisis countries, the ones that are, were until about last week were identified as crisis because the list keeps growing, okay? So this contains Sri Lanka, that's the blue line, Pakistan, which has also just gone back to the IMF. I think they're competing for who has more IMF agreements. At the moment, Argentina is still ahead, but by a whisker. Okay. Tunisia, which is the gray line, and Lebanon, which is already in official default. I think actually Tunisia is also in official default. So these are clearly crisis countries, right? So we would expect that is the terms of trade that is done. Well, let's look at it in the longer picture. Yes, for sure, terms of trade have collapsed since last year. That is, in the last 1 year, terms of trade have deteriorated rapidly. But are they that much worse than they were 10 years ago when everybody thought that all these countries were just doing brilliantly? They're back to the same levels of a decade ago. So you had a hump in the mid-2010s. You had another hump in just the period immediately after the pandemic, during the phase of recovery that I had mentioned. And yes, you've got a decline now. There's no doubt. There is a decline in terms of trade over the last year, but it's not that bad. It's not enough to justify the complete calamity that we now see in emerging markets. So obviously, we have to look somewhere else for the problem. And I think that problem has already been identified so clearly and comprehensively by Chandru that I don't need to waste too much more time on it, okay? You have these low interest rates, which encouraged much more borrowing all over the world, cheap money everywhere sloshing around. And people always say that, oh, these emerging markets and these frontier economies, they borrowed too much. Well, hey, we borrowed much less than, let's say, anyone in the US. You look at corporate debt, household debt, student debt in the US, it exploded much more rapidly than our debt did, okay? But nonetheless, definitely we did. The big change for us is that we also got into bond issues, which we hadn't. Why? Not because we were not thinking of it, but because global capital markets hadn't considered us worthy of bonds. With IMF actively cheerleading, we were all encouraged to float bonds. We were encouraged to tell our corporations to float bonds, and governments issued sovereign bonds. And I'm sure we'll hear much more about those from Ahilan, for example. So you have Davos and you have the IFIs all cheering this on and saying, great, great, because now they're accessing private capital and everything is fine. But of course, as we know, the COVID pandemic meant that we were much more battered. Of course, there were the impact of the vaccine apartheid, which I'm not going to dwell on, but it meant that our sort of ability to even confront the disease was significantly delayed. But we couldn't do the fiscal response, as I mentioned earlier. And many of these countries already had very significant debt, short-term and long-term. And of course, the ones that I have identified earlier were very much part of that. So then you have the Ukraine war and the associated declines, not in exports, but in other things, in the difficulty to access certain kinds of arrangements and the need imposed by sanctions to circumvent sanctions by doing more complicated arrangements that, as Jomo mentioned in the morning, were more expensive, okay? Then the US decides to increase interest rates. The US and the EU, in a peculiar death wish, decide to increase interest rates. And so you get a flight to safety with self-fulfilling effects on all of us in terms of the balance of payments, in terms of the currency depreciations, in terms of all of the kinds of things that have been mentioned in the earlier session. So essentially, this was a tragedy foretold. I think any of us in this room could have said, this will happen if the following things happen. But what is really also extraordinary is that we're not the only ones. The World Bank and the IMF saw this coming. If you look at their reports of 2021, they also said this. It's just that they did nothing about it. I mean, that debt service suspension initiative was just pushing the can down the road without much change in the size of the can, in fact, an increase in the size of the can. And the other process for the restructuring of debt is debt in the water. It doesn't exist anymore. So what's next? And this actually is a slide I just added on the basis of the discussion we were having in the last session. I think Chandru has argued that advanced economies have reached the limits to fiscal policy. I'm not so sure. I would put it the other way. Number one, I think there is a whole legacy of the past spending. We have seen fiscal spending of a kind that has never been observed in global capitalism. Even the FDR New Deal is smaller than what the US has put out in pure money terms over the last 3 years, okay? And there has to be some legacy or impact of that. It can't just sort of dissipate immediately, that you stop it and it's over. But I would argue that it's even possible that monetary policy has reached its limits. You know, you can't, I mean, okay, you can raise interest rates. It might control inflation, but it's obviously not going to do anything for expansion. If anything, it will create recession. And I'm not so sure big corporations are going to be happy with recessions. So a lot will depend on how big capital in the US and EU sees their own interests, whether they actually would prefer a control of inflation, even if moderate, as was mentioned in the morning, or they would prefer future possibilities of expansion. So I think this one, I mean, I don't know, I would welcome a discussion. I'm grappling with this myself, but I'm not so sure that it can be, you know, this either or. But there is the other thing, which is, you know, there is clearly global trade fragmentation. This happened well before the pandemic. It happened with Trump, really, and his sanctions on China and the need to find alternative routes, the reshoring, which became not just reshoring, but also finding alternative routes. And the possibility that you can't anymore rely on any one set of providers for any particular commodity. Now, does that in turn impact advanced economies, fiscal and monetary policies? Again, I think I'm not so sure how and in the different ways in which this would impact. But certainly it does mean that it would require us, LMICs, to generate alternative trajectories of trade, whether regional, bilateral, plurilateral, and alternative patterns of trade credit, alternative patterns of swaps, alternative patterns of financing as well. So I would argue that for the developing world, at least, you know, to cope with this situation, the final point that people were making in the last session, I would say that it depends really on three big things. One is how much we can actually de-link from the current debt and financial arrangements, because many countries have legacy debt. A large part of it is private. You renege on your private debt or you default on it and you face all kinds of problems and sanctions and inability to access new credit in the official global credit markets. Perhaps it may not have the same impact in the new alternative arrangements that are being worked out as we speak with Russia, with China, with a bunch of other countries. How much can we rely on external capital? Not necessarily for anything else, but for the technologies. We really need technologies to deal with future health hazards, to deal with climate change at every level. We know we're not going to get the finance for it, but at least can we access the technologies for it? And finally, the thing that I said wasn't such a problem because we were back to where we were in 2012. But if terms of trade deteriorate further, then it will be even harder for us to do something that is of significance. But okay, let me stop here. Thank you. Oh, sorry, conclusion, very important. Sorry. I mean, you can read it, but let me just say it. Don't blame the pandemic. Don't blame the Ukraine war. Don't blame the trade patterns for the current crisis. The real problem is the neoliberal and neo-colonial model of which is still being promoted at global levels and at national levels. And the only way we can revive is to respond to the current flux in the global economy by abandoning that model. Okay, thanks.